Managing bank liquidity, BAU versus stress scenario planning. Bank liquidity management is a crucial aspect of the banking industry. Ensuring that a bank has enough liquidity to meet its obligations is essential for stability and financial health. In this video, we will discuss two key approaches to managing bank liquidity: business as usual, BAU, and stress scenario planning. Business as usual, BAU. BAU liquidity management involves the day-to-day management of a bank's liquidity needs. Banks employ various tools and strategies to maintain sufficient liquidity levels. These include liquidity monitoring. Banks continuously monitor their liquidity positions through various metrics and ratios to ensure they have enough cash and liquid assets to meet their short-term obligations. Liquidity buffers. Banks maintain liquidity buffers, such as cash reserves and highly liquid assets, to handle unexpected events, regulatory requirements, and fluctuations in customer deposit levels. Funding diversification. Banks employ diversification strategies to secure funding from various sources, reducing their dependence on a single funding channel. Cash flow projections. Banks use cash flow projections to analyze and forecast their future liquidity needs. Contingency funding plan. Banks develop contingency funding plans, CFPs, to outline actions and strategies to follow during periods of stress or market disruptions. While BAU liquidity management focuses on maintaining day-to-day liquidity needs, banks also employ stress scenario planning to prepare for severe market events. Stress scenario planning. Stress scenario planning involves simulating extreme, yet plausible, scenarios to assess a bank's ability to withstand adverse conditions. This proactive approach helps banks identify vulnerabilities, quantify potential liquidity shortfalls, and develop contingency measures. Here are the key steps involved. Scenario development. Banks create stress scenarios by identifying potential events that could significantly impact liquidity. Liquidity stress testing. Banks conduct comprehensive liquidity stress tests to simulate these scenarios and assess the impact on their liquidity positions. Contingency planning. Based on the results of stress tests, banks develop detailed contingency plans to address potential liquidity shortfalls. Regulatory compliance. Stress scenario planning is also an important regulatory requirement. By integrating stress scenario planning into their liquidity management strategies, banks can enhance resilience and readiness to handle adverse market conditions. In conclusion, managing bank liquidity requires a combination of business as usual, BAU, practices, and stress scenario planning. By implementing robust liquidity management strategies in normal times and preparing for severe scenarios, banks can ensure their financial stability and ability to meet their obligations even in challenging circumstances. Want to learn more? Claire Trifle on LinkedIn